Hi, welcome to Wall Street Beats.
Hi, Mom.
It's Monday, February 10th. I'm here with two of my favorite people, Jeff Mackey and David Maris. We're going to talk about Walmart and Costco to start off the show, because I'll give you a little backdrop on it. Friday, I was going on a little bit of a tweet tirade, if you will. I was going stock by stock at the top of the market and showing how there was a bunch of momentum decay. But there was two obvious ones that there was no momentum decay, and that would be Walmart and Costco. And no one better to talk about this than someone who has a large position long both of them and is our resident Mr. Retail consumer guy. And we were just thinking about, how do we think about that as a long? Is there a way to protect yourself? And where do we think these stocks are going? So let's kick it off, Jeff.
As little as possible is how you think about them as a long, because if you think about these a lot, you sell them. And the truth on Wall Street is it's if you sell all your winners, you end up with a portfolio loser. So I'm less bullish than, as we were talking about, trap long. That's the best you could do it in both these cases. Costco has just been doing the same strategy over and over again. What I found interesting as I was digging into this is a chart, like you said, the momentum's not weakening at all. So every time you want to sell these things, here's these two stocks year to date. It's not like their earnings exploded for the last decade, let alone over the last month. But Costco continues to just chug 10% comps in the January. The stocks both just kicking the living crap out of the S&P, and they seem like fantastic places to put your money until, to the point of the charts you're sending out, you realize that Walmart's earnings really haven't budged much in the last 5 years, 10 years. They're growing at GDP type of rates for their top line, and there are no more worlds to conquer for them. But that's where the rub comes in. And the question is, why are people buying Walmart here? Why does the stock so sticky to the upside when there's not really an earnings justification? To me, it's investors really playing off Amazon's playbook. Amazon, if we saw that report last week, I wrote about it elsewhere. That was a quarter, you got to buy that dip. You don't get bearish on Amazon when Amazon has stuff to spend on, because they're some of the greatest builders of businesses that are flywheels of retail in the history of the industry. They've created 5, 6 multi-billion-dollar operations. Retail to them is almost just this huge top-line, low-margin business. Walmart's been cranking out 4% margins. That's not super exciting, but with the chart, the stock is really being led by CapEx. CapEx has gone up huge there. And Walmart went from really being a let's focus on cost, let's drive down cost as much as possible, the Costco model, to let's explore kind of the opportunities that we can do with other businesses, advertising. What can we do with tech? What can we do with AI? It's when you're operating even low margins, Walmart's so huge at this point, you got 30 billion of cash that's coming in, and you got to figure out where to put it. They've got a place to put it. They're pretty good deployers of capital. They're run by pretty smart people. And I think the bet here is that you're going to see things like third-party selling, which Amazon's taken the lion's share of simply because they have the best logistics now. Walmart's got 12,000 stores, 10,000 stores. Within basically 95% of the country lives within 10 miles of a Walmart. They can do logistics with anyone. That's a huge business. Third-party selling is a huge business. And I think that's where the profit idea comes in later. It's good as a catalyst from a stock market perspective because you don't really need EPS next quarter. It's third-party services. That's not going to be something that drives a huge number for Walmart in the next 6 months. But if I can see momentum on that front, it's such a better margin than that 4% historical business that you're talking about billions of additional earnings. And I think that's what the market's pricing in, is just efficiencies that'll come online later. It makes it hard to sell. Of the two, frankly, I think Costco is arguably more ahead of itself just because it's eventually that story just gets played out. You don't want your discount stores to become the hot thing the way Costco has become, because it's just a club store. They're not going to be able to keep that sizzle going for very long.
Yeah, it's a great model, right? If you think about why these two businesses have emerged as the two dominant bricks and mortar retailers in America and now moving around the world, is let's go back to the rise of China and making stuff cheaper for Americans. They just took and passed that along, right? I know a guy who was a private equity guy tried to sell into Costco, and he was like telling me, like, because they do all the work down to the detail level. He's like, they take all the cost out there. It's like, you can make the accepted gross margin selling to them, which is very thin, and understand that you're going to make it up on volume, and they pass it on. When the customers like Walmart and Costco, the employees seem to like Walmart and Costco because they're paying better than the rest of the guys, and the stock market clearly likes them. There's a lot of love for it. And I guess that's what's reflected in the multiple, right? Is that fair?
Oh, totally fair. And you think about kind of growth opportunities for them, and you look at Amazon third-party pricing. It's those are that kind of becomes the equivalent of the folks that would sell like a bird feeder or what have you, a one-off product to Walmart, right? Everyone lives their dream, and there's all these stories of people that, oh, we got a huge order from Walmart, and it's going to be we're saved forever, and then they find out that they make half a penny per bird feeder, and it turns out to be terrible for them. In other words, the company itself grinds out all the profits. That's what Amazon's doing on third-party selling, which are goods that they don't have to market, they don't have to sell, they just charge for companies to advertise them on Amazon. Then they do all the fulfillment themselves. Then they've got the bus. And so when you get down to it, Amazon's kind of taking the lion's share of that margin. It's $150 billion a year business for them. That's a whole target and a half that was created from nothing by Amazon over the last 7 years. It's much better margins than selling stuff out of a huge box store. And you're eating into that ecosystem of retail itself, which is the other thing you notice with these stocks. Costco and Walmart are trading at 5-6 times the multiple of Target. And as a Minnesotan, I would love to have that be my cue to get long Target. As an investor, Target's dealing with shit that Walmart and Costco just don't have to bother with at all. They've been left in the dust, and if Walmart's out there spending $10 billion a year on upgrading their tech and providing services and third-party selling and advertising, Target's not going to be able to do that. They're not even close to being able to do that. And that's a real problem. When I hear when Target's talking about, oh, we can get deliveries in 5 days, just holy shit, is that way too slow to be delivering product to customers when Amazon's able to do same day without even promising. It's just like, oh, I ordered these batteries this morning. Cool, they're here right now. These are better mousetraps.
Yeah, that is a great point. It's just difficult because what do Americans like? They like good prices and they like convenience and they like consistency, right? And cost, convenience, and consistency, the 3 C's, let's call them. And if you're that much of a differential on those, it's going to be tough to take share without doing it at some crazy margin where you're not making any money. What is the situation where they get hit? Is it other than just broad market sell-off? Forget about that.
It's going to be a flat out failure. And so the broad market sell off, obviously, that is where optimism goes to die. And so all of a sudden you'll rip that out and people are like, oh my God, Walmart's at 35 times earnings. No shit. But where they really get hurt, from my perspective, as someone who's willing to give them a little bit of benefit that they might be able to make third party selling or one of the other flywheel operations that they have into a big industry, is I need to see them just outright fail. Just do kind of reversal. I need to see evidence that they're not deploying their capital effectively. If this advertising doesn't get some traction soon, for instance, that's going to be a red flag. If their e-commerce can't keep pace, because that's going to be a big driver. The advertising is what's your placement look like on our website, and that's going to help the vendor or the companies move a ton of product. If Walmart's not able to monetize things like that the way Amazon has, then it becomes increasingly hard. Then you return to, okay, this business is literally all over the world. There's no way they can grow faster than GDP on the top line unless they figure out other businesses to go into. They've conquered everything they can in their niche of retail.
Do you consider anything of, hey, these multiples? Maybe Jen, you can pull up this chart. When I just look at, you can pull either one. Yeah, there's cost or Walmart's. So we're at these like multiples that look pretty peakish. We could keep going. But is there any nervousness? Okay, maybe I'll take a little bit of my win and buy some insurance on it, or are you just riding it?
I think these are pretty good insurance, particularly Walmart. The options are always dirt cheap there, and you don't want to be throwing it all the way on that. But man, you can buy some. They come out. It's hard to figure a hyper disaster. Again, for Costco, you want to hate them, but if they're comping at 10%, their quarter's not going to be all that bad. And that stock is it's harder to hedge. For Walmart, people price in about a 3% move per quarter. They're reporting next Thursday. If they blow up, it's going to be by more than 3. Down 10% day would not be the hugest tragedy in the history of the world for that stock. And so maybe there is. What are you seeing out there? You trade a lot more options than I do.
Yeah, I don't know. I guess like it's not that cheap. Like I'm looking at, if you wanted 1 year, so let's go to December. The at the monies are $7. That's not that cheap. If I'm going to pay $7 now, I can go down a little bit. $5. It's not. I would want to pay 2%, 2.5%. 7% for my position for the year. It's not great. Yet you're speculating a bit there, would be my view. I think with where the implied vol is like 25, it seems pretty high of a price to pay for Walmart, right? Remember, this is the business that in 2008 actually traded well, right? And now it was at a different multiple and stuff. But the problem with shorting Apple and shorting Walmart and Costco is that in an actual cyclical rollover, they are the places that will be steady. The difference now is they just haven't had these multiples. So that's one of the reasons we thought it was an interesting time to talk about, especially with Jeff being long, both of them, and knowing the names very well, is it's a unique situation where there's not a great answer, honestly.
And other than, again, the stuff we talked about, but that's real soft, right? It's hard to stuff optimism over future CapEx payoffs into your spreadsheet. You can come up with a bunch of numbers for it, but it's all bullshit that you're just inventing yet. Analysts don't have a magic ball any more than Walmart does. It was that easy to do. This will be a 10-bagger for us. They can't say that. Each initiative could fail. And so you just have to play it out. You're looking for some sort of comparable. And the comparable for Walmart is they're going to creep online the way Amazon's creeping into physical. And if you're a third-party seller, you really want Walmart to be good. Like, people who are selling products online want a competitor to Amazon, because right now Amazon's a 15,000 pound gorilla. It's the king freaking Kong of selling shit online at this point. So they want Walmart to succeed. There's a lot of reason to think they're going to get penetration. They're going to get some traction on it. It's just what price do you put on it? And with Walmart, it's a unique kind of company because they're so huge, but it really is just a 4% net business, which is unbelievably horrible compared to a software company. So almost any business they get in that pays for itself is going to be a net improvement for what kind of margins they generate, just as an overall concern. There is the case to be made that margins aren't going to get any thinner. So maybe they improve. And here we are at 37 times earnings on that very thin gruel of an idea.
Yeah. One final thing for you. Do you think that they will ever raise the price of the hot dog? Or is that $1.50 like the gold standard when gold used to be fixed at $35?
We will be ice skating in hell before they change the price. Costco's entire shtick is, man, we charge you membership, but that's so we can make everything cheap, as seen by our hot dog. Like, they will point at that hot dog. The price of whatever it is you put in a hot dog could quintuple from here, and hot dogs would still be $1.50 at Costco.
Love it. They're doing well. There's no argument. I'm happy for you. You made a bunch of money. It's been great stocks. It'll be interesting to see how this year plays out with both of them. But I think it's a good conversation for our subscribers to just hear from the mind of a guy who knows the space and also has his money where his mouth is on it. So let's move on. David, how are we doing today?
Doing great. Thinking about the Super Bowl and the ads. I'm interested in hearing what you guys think that the ads, which were the best ads. I have to say the Budweiser ad, which was a dead brand for a while. They did pretty well. At least they got my notice. I'm not a beer drinker, so for me to notice it, I was like, oh, it's interesting, upbeat and happy. Another one, though, that I can tell got people nervous. Going into it, the Hims commercial got a lot of press, especially from I'll say the pearl clutching, hysterical people from the financial press, especially the ones that are tied to Novo and to Lilly. And they're like, this ad is going to it's so bad. They don't talk about the warnings about what could go wrong with GLP-1s and compounding pharmacies. It's really, that tells you who's short, and it also tells you where industry is. I thought it was a great ad. And another sign of how nervous it got people, during the middle of it, while it's playing, someone who I know is short a lot of stock, an institutional investor, texts me, what do you think of the ad? Now, the ad had been out for a week already, and I had already given him my opinion of the ad, but I guess live it was some sort of different thing. There is a guy on X who, there are lots of marketing experts who rate the ads, but there is one in particular that I saw who doesn't do healthcare only. He just looks at all different ads. And he's like, that might be the ad of the night because it was straightforward. It hit the messaging, blah, blah, blah. Now, the stock's up a little bit, but the stock that I want to talk about is a stock that I missed that is probably one that I should just buy today and just say, okay. But TDOC or Teladoc, TDOC, if you look at that stock price in just the last 4 or 5 days, ever since RFK looked like he was more likely to get approved than not. Now it's still not 100%, but you go from $10 to $13.60 or so. That's a big move for us. I just need a couple of those and I'd have a happy year. But excuse me, if you look up 34%, they're essentially another telemedicine company. So it's not exactly like selling GLP-1s, but similarly. And if you notice, there was Roe and others that private companies that were out during the Super Bowl flooding the airwaves with that. What I thought was interesting is some of the press turned around and said, yeah, isn't it great that they're bringing in the dialogue of how the system is broken? Now, they're not, they don't really believe like the system is broken or the system is broken, sure, but I'm going to sell you drugs anyway. So I don't know how they're not part of the system at just a cheaper or lower price point. But I get what they're saying, which is accessibility. If you need a doctor for certain very specific things, they're an option. But other than that, I thought it was surprising. The Pfizer ad got a tremendous amount of blowback. So here they are talking about childhood cancer, and it got a lot of praise because it's a very emotional ad. If you haven't seen it, you should watch it. Or if you didn't pay attention because your team was losing so badly, it's a beautiful ad. It's very touching. It's a childhood cancer. Mama Said Knock You Out is the soundtrack. So LL Cool J. And this is a little boy who is leaving the hospital after chemotherapy. And Pfizer says, look, we're working on 8 blockbusters to prevent cancer or to treat cancer. And that's great, except a number of people, especially whether you consider it a conspiracy or you consider it, no, that science isn't there yet. I'm not going to wade into that. But some group of people believe that Pfizer's COVID vaccine may make you more susceptible, may cancer. And so they cause this problem. And now, look, they're trying to solve it with medicine. Now that's I think it's a big leap, but the blowback on that was actually interesting to note. So the industry is not, even when they have a touching ad, they're not helping themselves too much. So I thought that was another interesting one. I think it was the only other healthcare focused ad. But I'm interested if you thought the
I
InBev
thought in the
ad or
same vein, it's the same kind of. I look to the ads as a consumer guy. Just are these companies in sync with what they actually have going on with the company? I thought Nike's ad was terrific, and they continue to be a shop that makes a nice little 30-second ad. Unfortunately, they're a dog shit shoe company right now. And so they show this great kind of women's athletics ad. They have a lot of Caitlin Clark, who's the most famous, deservedly so, female athlete going. And I turned to people that I was watching the party with, and I'm like, they don't even make a Caitlin Clark shoe. Holy shit. Like, it's this, and they're not going to have one for another year. This calendar year will not have a Caitlin Clark shoe. Nike's paying this woman, putting her in ads, and they don't have product to sell. This is a company that there's a reason they're making brand new fresh lows, and that's pretty much it on display. It reminded me, and for good reason, about Nike talking about their ubiquity at the Paris Olympics at the same time that they missed revenues by about 15-20%. Congratulations on being famous. You should sell stuff. You should use the opportunity to maybe move a little product. It's not really going to take you a full year of R&D to make a shoe for Caitlin Clark. What the hell is she wearing right now? Sell that to girls. Sell that to like 100 million girls that play basketball in this country, and move some freaking product, and let's talk about them. But in the meantime, when you see that lack of synchronicity between what the company's saying it's doing and what they're actually doing, it is a little bit jarring, a little bit weird.
Actually, some of the blowback online was that, hey, Nike, great ad, but when we needed you to stand with us, you didn't. And then they had photos of President Trump signing the No Men in Women's Sport executive order. And so you're right. It's like, do you know where you are right now in the zeitgeist? And do your ads match
Read the
that?
room. Right, exactly. Read the freaking room. And maybe just shut up about all the activism. Just sell people shoes.
Yeah. And like you said, if they had just Caitlin Clark shooting 100 threes in 30 seconds, and then just said Nike, that would be way more compelling, I think, even though it was a really touching ad. Ben, did you have anything? Were you like, oh yeah, go Budweiser, go?
No, I'm long gone, as you guys know, but I was at a bar that there was no noise during the commercials. They played music. So I watched them with some subtitles, but I didn't get the commercial experience. There was rap music being played or something, so I can't really offer much other than I'll say two things. First, hymns. Congratulations, David. It's $44. I think we can announce that you were the winner of the Russell versus David hymn. That's been
We've beaten that
fantastic.
one to death. We've beaten that one to death. So.
And then the second one was McDonald's this morning had a meh, kind of a meh. What do you think, Jeff?
Yeah, a whole lot of meh. Really nice reaction to that, though. That was a super nice reaction to the company itself, basically saying, yeah, people just aren't that fired up on what we're doing right now. That's another story where, that business has changed so much from actually running units to just being a bully franchisee guy. But it's a great reaction. And to me, McDonald's is always one of those stocks, like Walmart and like Costco, where you know what you're going to get. They don't surprise all of that often, and when they do, it's a big deal. This wasn't a quarter where it was a big deal. It's the consumer continues to be value oriented. Holy shit. It's just put that at the top of your earnings release every single quarter, McDonald's, because that obviously is talking your own book. And also, if Costco's posting 10% comps, are we sure the consumer's in a lot of trouble? Are we sure maybe just some of these companies are in a lot of trouble?
I did want to mention one other thing. So I think I mentioned a few weeks ago, actually at the start of the year, that biotech had been beaten down so much that I'm going to buy a basket of them and let's see what happens. So I did end up buying 20, which is a lot, 20 different biotech stocks. And year to date, that portfolio's up like 15%. And some are up a lot and some are down a lot. So it's not as though the whole group moved. In fact, the biotech index, the XBI, is down year to date. It's underperforming the S&P 500. But one of the reasons that I think it's working is that the catalyst, as people are moving out of these, and again, not moving out wholesale, it's not as though you've seen the market crash, but as people are looking for other places to be other than NVIDIA, again, not today as the stock looks, but overall, I think as they're looking to beaten up areas where they can be like, okay, I'm gonna be here, even though I know it's much, much more volatile. But I'll just give you some of the ideas of some of the stocks just today. You have SpringWorks Therapeutics up 32% on rumors they might be bought out. Solid Biosciences up 23%. Axsome Therapeutics, which has been up 50% so far this year, is up 18%. Now, these are moves for, again, generally speaking, I'm not investing in stocks that move like that unless there's a takeout. Immunovant is up 3%. So I can keep going down of what's going on. But I think if you have catalyst-driven names, people are now willing to roll the dice on the catalysts, even if you could be wrong. But if you have a large enough group, maybe you're mitigating that because the overall risk is lessened than it was. Underperformance for 3 years in a row, 5 years in a row, probably makes it an okay trade. It's generally not an area that I play single stocks though. So I just bring it up as it's a crazy day in biotech land, and it's carrying a number of names along with it.
And one last thing on the McDonald's that I would note, and everyone here knows that I've been the local China bull. It seems like some people are starting to wake up to that. And McDonald's did say that their Chinese business was stabilizing a bit. Just thought that was an interesting little tidbit to point out to subscribers and listeners that the FXI and the AE shares are trading well. Baba's trading well. So we had that thing in September where everybody got caught short, then we correct, and now it's starting to assert itself again. Just interesting to point out. And then maybe if the best stuff in the U.S. is not very attractive because there's so many longs, it's time to start looking elsewhere for value, because the U.S. might not be the only place to be for the next however long. Just a little tidbit to finish the show on.
Didn't Berna bring up, is it DPC Dash, the Domino's player in China? The Domino's Pizza player in China?
I don't think I talked to her about that, actually, but I did see the Barons wrote up DPZ long this weekend. I don't know. Domino's was a great story. I remember buying that at $10 in 2010 or something. And then it's obviously because I'm such a loser, unlike Jeff, who holds, I sold it like 30 before.
Yeah, I think Yeah, I think Berta had brought it up before the Barron's thing, so not after. And so if you do think that Chinese names are starting to come around and maybe the consumer there is more open to that, and frankly, if they don't know good pizza from bad, maybe DPC Dash is the way to go.
I think that's going to be it for today. Thank you, boys. This is fun. We will see you guys soon. And don't make sure to check us out Wall Street Beats. Take care.